amid the large equity inflows into startups in these last few years, and then, of course, the funding winter, venture debt has been gaining popularity slowly, and it has now grown at a compounded rate of almost 22% in the last 3 years. According to a report by BCG and Trifecta, venture debt investments are projected to grow by 8 times to reach $6 to $7 billion by 2030. So let me invite the authors of the report to tell us more about this emerging trend. Joining me now are Anshuman Upadhyaya, partner at BCG, and also Abhishek Gupta, who's a partner at Trifecta Capital. Anshuman and Abhishek, thanks very much for joining us here. And Anshuman, let me start with you. $800 million was invested last year across 100 deals. How is this expected to grow as far as venture debt is concerned in the next few years, and what is going to be the growth driver?
Venture debt today in India only accounts for 2% of the overall VC investments in the country. In more mature markets like the US, this number stands at 15 to 17%. So this indicates a huge headroom for growth at the very macro level. Now, if you look at where this growth is going to come from, on the demand side, founders have realized and as the startup ecosystem gains more maturity, they've realized that they need a range of financing solutions to cater to their inventory financing needs, to their working capital needs, to their growth aspirations, and venture debt fits nicely in there. On the supply side, more and more investors are getting aware of this as an asset class and the risk return profile that it provides. So this also gives it some sort of support to reach the 6 to 7 billion numbers that we project at the end of 2030.
Abhishek, coming to you, we've seen more of the startups which are unable to raise equity at the valuation that they want pivot towards venture debt. But, to what extent can debt actually substitute equity capital, or will it just extend the runway for the next equity fundraise?
There are two components, let me divide it that way. One is the secular growth of the venture debt, which is linked to the overall growth in equity. And second is related to basically the cyclical side of the things, which are like, as you said, there's a funding winter out there and there is a need for like alternate form of financing to extend the runways. But having said that, overall, there are form of functions which need a part of equity and a part of functions which need debt part of it, right? So basically, for equity thing, you can have, imagine like your standard product developments, or when you're still like away from your product marketing fit, right? And then OPEX expansion, and then you have your customer acquisition. This should be ideally like financed by the equity side of things. But if I talk about the working capital, CapEx, right, acquisition financing, these are typical use cases for the debt side of the things. So it's not that, okay, it's a funding winter, that's why let's go for a venture debt. It's a process where you need to always optimize your capital structure, and depending on your nature of business use case, you should combine it effectively.
Well, it's not purely driven by the funding winter, of course, but when equity is not easily available, there is the option of debt, which has only emerged now in the recent years. But Abhishek, are there specific sectors where we're seeing more activity as far as venture debt is concerned?
3 segments, I would say, or 3 sectors, I would say, which are like where the use case of venture debt comes very natural. One is the venture consumer product and services. The second is the fintech, and third is what we have seen as a B2B platforms, right? So why these kind of business basically need more like an alternate form of financing? If you talk about the consumer product, consumer services, when like it's a working capital need, CapEx need, growth financing need, that's a very natural use case, right? For fintech, it makes a lot of sense to have venture debt for the onward lending piece. If you see, especially the fintech in India, they are more targeted toward the underserved segment, so they can justify that spread to have a venture debt for the onward lending part. And the third is the B2B, where it is a very working capital intensive kind of environment and platform. And there the venture debt use case is pretty strong out there. So basically, if you could see, if based on the research which we have done, 29% you can figure out for the consumer's product and services, 15 like around close to 19% for the fintech, and 13% for the B2B platform. That's the calendar year 2022 split for the deals.
Anshuman, coming back to you and leaving equity aside for a moment again, there are various kinds of debt even within that, which is available to startups as financing options. What's driving them towards venture debt specifically?
If you look at the entire life cycle of the startups at the early and growth stage, early to growth stage, there is not a lot of revenues that a startup generates. The product market fit is also something that the startups are trying to figure out. So at that stage, once the startup starts to generate some sort of revenue-based financing can be accessed. However, that's a costly form of financing. The interest rates vary from 20 to 25%. Now, if you look at on the other end of the spectrum are the bank loans, right, which is more for the late stage and the mature startups. So that's the cheapest form of financing. However, not every startup has access to that. In the middle is venture debt. So the interest rates are in the middle, 13 to 15%, and the ticket sizes are also larger. So it typically it's around 20 to 25% of the entire fundraise. So that helps the startups cater to the different growth use cases that they have, whether it be M&A or your capex financing or your working capital needs. So all of those needs get catered to by venture debt, which are typically larger in ticket size, right? In addition to that, in our survey, what we found out was startups value the strategic partnership that venture debt funds bring in, right? So they're, in a sense, venture capital investors who come to the the startups and provide some sort of strategic input to the startup founders, and they value that a lot.
On that note, it is time for us to head into a short break. But coming up next in our special series, the Unicorn Health Check, we put the spotlight on India's online gaming unicorns. Stay tuned for that.